Hey everyone, Iggy here from the Investing Iguana, and today I want to sit you down like we're having Kopi together because the banking world is full of loud warning bells again. Maybe you've seen headlines about US regional banks wobbling, stuff like fraud losses piling up, commercial real estate collapsing, delinquencies spiking. Let's make sense of it, especially what it means for us in Singapore or even Malaysia. Maybe you're thinking, why should some office buildings in Austin or San Francisco keep me up at night? That's fair. But as we'll see, this isn't just Wall Street noise. It's a major lesson in how risk management, good old CPF guardrails, and boring dividend strategies become superstars when the world shakes. Here's what we'll break down today. Why this round of panic isn't just random, what's really going on with regional banks and commercial property, how fraud and credit stress are starting to swirl together, why global investors get dragged in, yes, even us. And I'll give you my personal take as a Singapore-focused investor. If you're new here, I've spent years breaking down investing in Singapore, so you don't have to stress and untangle all the market jargon alone. So, first up, the commercial real estate time bomb. Here's the key. American regional banks didn't just dip their toes into commercial property debt, they jumped in up to their ears. About 44% of their loan books are in commercial real estate, more than triple what big banks hold. Picture this, over $1 trillion of these loans start coming due by the end of next year. Most of these loans were written when interest rates were what we'd call almost free money. Now, with rates so much higher, everyone's panicking. Can property owners actually refinance these loans? The office sector is in a real mess. Office loan delinquencies are spiking to levels last seen back in 2008. The average US office vacancy is nudging 20%. But get this, cities like San Francisco, Austin, and Seattle are in a league of their own, with up to 29% of all offices empty. Imagine a table, right? San Francisco is basically a ghost town for offices. Austin and Seattle not far behind. National average isn't exactly comforting either. What does this mean? Banks with big bets on these office-heavy cities are facing the highest risks and headaches. And here's the tricky bit. When property cash flow dries up, property values tank. Now, banks can either pretend the loan's fine by extending it and hoping for a magical recovery, extend and pretend, classic move, or admit damages, force defaults, and eat bigger losses. Which would you choose? Most are delaying the pain. But let's pause on this. Why should we care if banks are playing kick the can? Well, the more banks keep zombie loans alive, the less money they actually lend to healthy new businesses. That's like keeping wilted plants on your balcony and never buying new ones. That's like keeping wilted plants. Now, beyond all this real estate drama, there's another villain, fraud and consumer loan stress. Some big US bankruptcies like First Brands, Auto Parts, and Tricolor Auto, a subprime car lender, have rocked the system. These folks were double pledging collateral, basically using the same IOU for multiple loans. That's like borrowing from two uncles with the same pawn ticket. Suddenly banks, some big names included, are taking major hits. On the personal side, delinquency rates for credit cards and car loans are now above pre-pandemic levels. Auto loan defaults alone have jumped 50% compared to the last decade. Student loans in the US, those delinquencies shot past 10% after repayment resumed. Picture another simple table. Credit cards, auto loans, student loans, and overall debt, all pointing up on the risk charts. This isn't just a niche problem anymore. Now back to the property markets for a second. Let's talk about CMBS, or commercial mortgage-backed securities. These are supposed to be relatively safe bundles of commercial property loans chopped up and sold to investors. But in August 2025, the overall delinquency rate hit a record high. Office and apartment loans in these pools, worst numbers in years, if not ever. So if you had a visual table in front of you, you'd see office and apartment property stress lighting up red, while retail is even surprisingly stabilizing. What's the big takeaway? The current pain is sharpest where offices and apartments can't fill their units or keep tenants paying. Not all regional banks are equal risk takers, by the way. Some have way more commercial property exposure than prudence allows. There are banks with loan concentration ratios up to 4 times above guidelines. Picture hundreds of little dominoes lined up, one serious loss, and you could see a nasty chain reaction that goes way beyond just a few bad apples. And here's the echo. Remember the 2023 banking drama when Silicon Valley Bank showed how uninsured deposits plus bad risk controls could explode into crisis? That wave took down Signature Bank and First Republic too. This time, the headlines are about credit quality. Real loans going bad, sometimes thanks to fraud. But it's the same root problem. Concentrated risk plus poor controls equals sudden shock. Now cast your mind forward. When these US banks started confessing problems, the pain didn't stay in America. Stock markets around the world got a shudder. Gold set new records, everyone ran for government bonds, and even Asian banks felt some heat. Why? Because if US regionals pull back on lending, lots of global borrowers lose their credit lifeline. The shockwaves travel fast these days. Alright, here's the part closest to home. What does all this mean for us in Singapore and Malaysia? First, financial crises often creep up slowly, then bite hard, seemingly all at once. Banks extended and pretended. Then, a fraud revelation sends shares tumbling in a heartbeat. Second, this is where I want to pause and just say, regulatory guardrails matter a lot. In Singapore, our CPF system, and in Malaysia, the EPF, isn't perfect, but it keeps your core retirement stash mostly safe from these kinds of disasters. You won't get rich overnight, but your OA and SA balances don't vanish because an American office building is empty. Take your CPF OA, guaranteed interest with some lovely bonus points if you keep good balances. Special account and MediSave are even steadier. These returns might look boring, but they don't disappear in a market panic. Now contrast that with the SRS, Supplementary Retirement Scheme. Much more flexibility, but you take the risk. Invest in REITs, stocks, bonds, you name it. But if you're unprepared for ups and downs, a crisis can take a chomp out of your portfolio. So if you're using SRS, match your risk to your time horizon. Let's imagine another table for a minute, CPF versus SRS. CPF, steady base interest, high protection, limited investment choices, and only gradual withdrawals. SRS, must invest to earn, open choices, no guarantees, more flexibility, but also more responsibility and tax perks. Safety or freedom, it's up to you, but know exactly what you're choosing. Fourth, in times like these, quality dividend stocks and REITs come into the spotlight. Strong companies with reliable cash flows keep paying even when markets wobble. For example, when the Fed in the US started talking rate cuts in 2025, Singapore REITs saw solid gains because lower interest rates make their payouts more attractive. Similar story for our Malaysian banking heavyweights, which keep churning out stable dividends. If you spread your eggs like some Singapore blue chips, some Malaysian dividend stocks, some REITs, you're way more protected if one market takes a hit. Don't go all in on any single sector, especially not high-risk story stocks. Imagine another summary table in your mind. Singapore REITs performed poorly when US rates were rising but found their footing again once the Fed signaled cuts. Past performance matters less than understanding the drivers. Also, just a heads up, even Singapore banks, well run as they are, can feel the effects of global credit stress. Check if the stocks you own face big property sector exposure. Keep your emergency buffer ready. CPF is long-term. For short-term shocks, you'll want liquid savings or something you can cash out quickly. And never get overexcited about leverage. It's the same risk that wrecks banks, only on a smaller scale. Now, by the way, if you want all the comparison tables and the full written breakdown, it's on my Substack, link below. Super handy if you want to reference details later. Alright, quick personal take. Here's my honest sentiment. Financial headlines will scream about crisis after crisis, but each is just a stress test for your portfolio and your discipline. The real winners in investing aren't the fastest movers. They're the ones still playing the game decades from now because they stayed diversified and didn't panic. If there's just one thing to remember, keep your foundation solid, CPF, high quality dividends, some cash, then use extra risk money to hunt opportunities once everyone else gets nervous. Emergencies bring bargains, but only if you're steady. So if you're planning your next move, here's my bottom line. Don't let distant panics steer you off your plan. Diversify, keep cool, and focus on quality, not hype. What's your approach these days? Are you going defensive or hunting for bargains? Drop it below. I'd love to see what you're thinking. If you enjoyed this breakdown and want to join a community that dives deep into these topics with early access and all the nitty-gritty numbers, jump into my membership via Substack or the channel link. You'll get more than just updates. You'll get clarity, tools, and honest takes you can actually use. And if you found this discussion useful, check out my video on how Singapore REITs survive market shocks. It ties directly into what we unpacked today. That's all from me, Iggy the Iguana. Stay curious, invest smart, and I'll catch you in the next one.